Welcome back to the second video on accounts receivable. In this video, we're going to talk about valuation and reporting of accounts receivable. Reporting of accounts receivable is rather easy. It's reported as a current asset. So this is a current asset that's going to be reported in the balance sheet. It's going to be cash, accounts receivable, and then inventory. The reason it's listed before inventory is the item is already sold, or the services have been performed, and I just need to collect the cash. So it's one step away from becoming cash. It's a current asset. That part is easy. The valuation part is a little more involved. We want to report this at a net realizable value. If you recall, we had said accounts receivable are those amounts that we expect to convert into cash. In the normal course of business, all accounts receivable hopefully will become cash. But the key word over here is hopefully becomes cash. There's a business risk involved, and we want to find out what's the net amount that I'm confident of realizing. Realizing means converting into cash. Sales on account raise possibility of accounts not being collected, that's at risk of default, resulting in uncollectible accounts receivable. Sellers record losses that result from extending credit as bad debt expense. So any potential loss that I could have, I need to record it as a bad debt expense. Now, this depends on which method I'm using. I may choose to use the direct write-off method or the allowance method. The direct write-off method is not a conventional method. It's not the one that we use, but let's talk about it for a minute. In both cases, our journal entry that gives rise to the accounts receivable is based on the sale of goods or services, accounts receivable debit, sales credit. Now, in the direct write-off method, until I find out for sure that my customer is not going to pay me, I keep the receivables in my books. So I could have 30 days credit, 90 days credit that I've offered my customer. It could be a year or 2 years. I'm not taking it off my books until the customer tells me they're not going to pay me. When they tell me they're not going to pay me, at that point of time, I take the receivables off my books and I debit bad debt expense to indicate that this is not going to result in a cash flow. The problem over here is the matching. As I said, it may not happen in the same month or even the same year. I'm carrying the receivables in my books, and when I recognize a bad debt expense eventually, I'm recognizing it in a period when the sales did not happen. As opposed to this, the allowance method says that I need to do this adjusting entry at the end of each year. At the end of each year, I should be realistic and say what amount I think I'm not likely to collect, and that amount I write it off as a bad debt expense in that year of the sale, and I credit allowance for doubtful accounts, which is a contra asset account. It's contra to accounts receivable. So in the balance sheet, it'll be accounts receivable less allowance for doubtful account. The net realizable value is what's going to show up in my balance sheet. So the direct write-off method does not follow the matching principle. The receivables are not stated at net realizable value, so I continue to carry it at the gross amount, which is unrealistic. And this is not acceptable for financial reporting. The allowance method has better matching. The receivables are stated at net realizable value at December 31st, and this is required by GAAP. So this is the method we need to focus on, the allowance method. Now in the allowance method, there are two approaches. Once again, recall the journal entry that gave rise to the accounts receivable is accounts receivable debit, sales credit. In the allowance method, we're going to have bad debt expense debit, allowance for doubtful accounts credit. Now, I have to decide on how I'm going to come up with that calculation of bad debt expense. So there are two approaches. The first one is called the income statement approach, and the second is called the balance sheet approach. Let's take a look at the income statement approach first. In the income statement approach, I'm focusing on the sales number over here. And I say that a percentage of sales is going to go bad. That's how I do the calculation of bad debt expense. So I could do a percentage of total sales or a percentage of credit sales. percentage of total sales was done in the past when everything was being done manually, it was a lot easier to just take the sales number for the year and say, for instance, 1% of my total sales will go bad. What makes more sense is to look only at credit sales, because cash sales are not going to go bad because they're already cash. So if I take a percentage of credit sales, that makes a lot more sense because credit sales are the ones that we are concerned with. Now, as opposed to the income statement approach, I could look at the balance sheet approach. The balance sheet approach is looking at accounts receivable. Here there are one of two ways and I can do the calculation. I can take a percentage of ending receivables. So at December 31st, I'm concerned with the receivables I still have on hand. So of the credit sales, hopefully a majority of them have been collected during the year. Whatever is outstanding at the end of the year, that's the one I need to worry about. And I take a percentage of that number and I say that is going to be my bad debt expense. Now, what would be even better than that is if I can analyze the ending receivables and based on the age of the receivables, I calculate my bad debt expense. That's called the aging of receivables method. That is the most popular method now. Now with computers, doing the analysis of receivables is very easy. So basically what we are saying is at December 31st, not all receivables are equally risky. The older the receivable, the higher the risk. So instead of just assigning 1% and saying 1% of the receivables will go bad, I analyze the receivables. Let's say I have $10,000 in receivables. Let's just take as a quick example. I have $5,000 that is current, which means it's not yet due on December 31st. Maybe it's due on January 5th, January 6th. It's still not due. The risk is very low. As opposed to that, let's say I have another $3,000 that's 2 months old. Obviously that has become risky. And then I have another $2,000. $3,000 is 2 months old and I have $2,000 that is 7 months old. The risk is extremely high for that category. So based on the age, I will assign a different percentage. The older the receivable, I'll assign a higher percentage that it's likely to go bad. And based on that, I come up with a calculation of the bad debt expense, what the number should be. So once again, you have the direct write-off method and the allowance method. The allowance method is the one that we should use. It's up to the company to decide, the management to decide whether they want to use the income statement approach or the balance sheet approach. In the income statement approach, you could calculate it as percentage of total sales or percentage of credit sales. In the balance sheet approach, it's percentage of ending receivables, or you age the receivables and then assign a percentage to each of based on the age of the receivable. Again, companies have to use the allowance method. Almost all the companies these days use the aging of receivables method. So I have a few videos in which I have worked through these different exercises dealing with these topics. Please take a look at those videos.